Welcome to this video reviewing the India Market and Economy Playbook for June 2026. This comprehensive analysis covers macroeconomics, corporate earnings, and capital markets within a dynamic global environment. In part 1 of this video, we provide a macroeconomic snapshot, reviewing core indicators of India's domestic growth resilience, inflation constraints, and purchase sentiment. India's economy continues to show robustness, with a 7.7% GDP growth rate for FY26. While inflation metrics like WPI show some pressure, business activity remains strong as reflected in the composite APMI of 59.3. Regarding corporate earnings for Q4 FY26, revenue growth remains healthy across primary indices. While EBITDA growth has moderated slightly due to input costs, mid-cap and small-cap indices continue to demonstrate strong momentum. Market valuations show a clear divergence. Nifty 50 trades at fair valuations, while mid- and small-cap segments exhibit higher valuation ratios, reflecting investor confidence despite the potential for future margin pressure. Institutional activity in May 2026 was marked by a divergence. FIIs were net sellers due to global risks, while domestic institutional investors provided significant support, reaching record buying levels. Moving to part 2 of this video, we shift our focus to mutual funds, policy developments, and bond market dynamics. The mutual fund industry remains resilient, with total AUM reaching 81.38 lakh crore. Systematic investment plans continue to show strong year-on-year growth, indicating sustained retail commitment to the market. The Reserve Bank of India has maintained the repo rate at 5.25%. Meanwhile, government policy measures, including tax exemptions on sovereign debt, have successfully incentivized capital inflows. Geopolitical challenges continue to impact supply chains. Elevated crude oil prices and maritime transit disruptions in the Middle East are causing structural cost increases for Indian manufacturing. In the bond market, 10-year G-Sec yields compressed in June 2026. This, alongside tight credit spreads for corporate bonds, highlights strong institutional confidence despite external headwinds. A comparison of yield spreads demonstrates why policy interventions are necessary. Synthetic hedged yields for U.S. Treasuries often exceed local bond yields, making specific tax incentives crucial for attracting foreign investment. Part 3 of this video examines the global landscape, specifically focusing on central bank policies and capital flows. While India has maintained stable interest rates, many major global economies are in the midst of a tightening cycle, increasing interest rates to manage their own economic conditions. Finally, we observe significant shifts in global foreign portfolio investment. Markets like South Korea and Taiwan have experienced notable outflows, highlighting the broader trends affecting emerging markets in 2026. We now turn to part 3 of this video, which focuses on investor psychology and behavioral aspects. We explore whether chasing momentum can be detrimental to an overall risk framework. In high liquidity markets, retail investors often display momentum-chasing behavior. Over 63% of retail mutual fund flows are concentrated in small, mid-cap, and flexi-cap schemes. Historical data shows that such unrestrained runs are highly vulnerable to sharp mean reversions. Our strategy suggests staying focused on fairly valued blue-chip frontline equities, which offer better risk-adjusted rewards. Remember Warren Buffett's insight: the market is a voting machine in the short term, driven by emotion, but a weighing machine in the long term, driven by fundamentals. Thank you for watching. We hope these macro-driven strategic insights help align your financial goals. For more details, you can visit our website or reach out via our support email.